Good morning and welcome to the SCIROCCO Energy PLC Annual General Meeting proceedings. Throughout this recorded presentation, attendees will be in listen-only mode. Questions can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question submitted today. However, all questions will be reviewed with the responses published on the Investor Meet Company platform where appropriate to do so. I'd now like to hand you over to Alistair Ferguson, Non-Executive Chairman. Good morning.
Good morning, everyone. My name is Alistair Ferguson, and in my role as Chairman of SCIROCCO, I'm pleased to welcome you all to our AGM, both any shareholders that attend in person, but those also joining by audiocast. There are two or more shareholders present and the quorum requirement is satisfied, then I therefore formally declare the meeting open. I would like to start by just introducing you to my colleagues on the board who are seated with me at the table here. Tom Reynolds, on my right, our CEO, Don Nicholson and Muir Miller, our two independent non-executive directors. We're also joined by Doug Rycroft, our Chief Operating Officer, and Brian Tuma, from our legal counsel from Pinsons. We have in the room with us, just for those on the audiocast, we have in the room with us, we also have representatives from our nominated advisor, James Spinney and Richie Baumer from Strand Hansen, and John Crinks and Ben Romney from our PR advisors, Buchanan. Before moving on to the kind of formal business, as outlined in the notice of AGM, I would like to begin proceedings with both an introductory statement and then a presentation. Now, it has been a transformative period for the company. As following an extensive 2-year sales process, we reached an agreement with Wentworth Resources for the sale of the Rovuma asset in June of this year, for a total headline consideration of up to $16 million. Now, as I stated upon assuming the role of chairman in 2018, the profile of the company's legacy Rovuma asset was not an appropriate match for a small cap company like SCIROCCO with no existing production to support cash flow, given the ongoing funding requirements and technical risks involved. Now, while we acknowledge there were those long-term holders who invested primarily to gain exposure to Rovuma, who are disappointed with the outcome of the vote where shareholders approved the deal, it remains the firm and considered opinion of the board that the confluence of risk factors, technical, subsurface, and financial, for example, resulting from ongoing cash calls, was such that the company would have been placed in a terminal position were it not able to dispose of the asset. As per my letter to shareholders on the 21st of June, the reality is that the company would have been required to fulfill its near-term funding obligations on the asset by raising further equity, likely far in excess of its current market capitalization, and at a level of issuance and price that would have been highly dilutive for existing shareholders. Now, furthermore, in the current environment, there were absolutely no guarantees that the company would be able to raise the necessary capital required, which would in turn lead to the company defaulting on its financial commitments and potentially relinquishing its interest in Rovuma for nothing. With this in mind, I think it is necessary and appropriate to reiterate that as directors of the company, the board's primary fiduciary and regulatory responsibility is to act in the best interests of the company and all its shareholders, and it is our strong belief that this deal was the best way to achieve that. We remain confident that it was the best deal available to the company, removing a major overhang, while retaining exposure to the success case and providing the balance sheet strength that allows us to pursue a new strategy. The new strategy that's focused on sustainable energy and the circular economy. An investment policy that was overwhelmingly approved by over 99% of the shareholders in this same forum last year. Now, the company has made its initial investment in line with the strategy in August last year by acquiring a 50% interest in Energy Acquisitions Group, known as EAG, creating a joint venture platform capable of leveraging EAG's strong network and industry-leading expertise to gain access, to a pipeline of attractive cash-generative opportunities within the anaerobic digestion and biogas market. In October 2021, the JV made its first acquisition of Greenon Generation Limited and its 0.5 megawatt anaerobic digestion plant in Northern Ireland. Now, as demonstrated through the operational improvements implemented to date at Greenon, which has seen revenue increase by 34.5% year over year at the end of Q1 2022, EAG's team brings significant operational expertise in the anaerobic digestion sector, and we expect to meaningfully progress further similar opportunities in tandem over the coming months. Now, our investment into EAG and the resultant JV platform positions the company within the energy transition space at an important juncture on the journey to net zero, and allows us to target a significant and growing pool of capital in the low carbon sector that was previously unavailable, as ESG headwinds limited the availability of funding for small, single asset oil and gas players in recent years. So to conclude, we expect a timely resolution on the outstanding situation with regards to preemption rights and right of first refusal on the Rovuma divestment, and look forward to the successful completion of this transaction as we move forward as a well-funded, strategically focused company with a clear vision to deliver sustainable long-term value for the company's shareholders. So thank you. That completes the opening statement. I'd like to invite our CEO, Tom Reynolds, to give a short presentation on the current SCIROCCO business and the future plans. Tom.
Okay, thank you, Alistair. So basically, as Alistair said, I'm going to take you through a short presentation now, which will cover a few key themes. I'll draw your attention to this disclaimer, which you should review at your own time later, but really just sets the information we're sharing here in context. And the points I will talk through here, Alistair's obviously covered the opening statement, and I'm going to take you through a 6-point presentation, which will cover the Rovuma divestment, as Alistair's already touched on, the investment we've made in EAG, comment on board performance to answer queries we got ahead of the AGM, some information on the Nice Energy relationship, the prolific basins facility, and then finishing off with strategic objectives. And then we'll open the floor to questions from the floor and from pre-submitted questions, and any questions that arise from the webinar here. So to kick off on Rovuma. So the Rovuma disposal, as Alistair's already indicated, was a divestment that is wholly in line with the strategic pivot that we have made and messaged as a board over the last 2 years. I really can't overstate the level of consistency and communication we have pursued over the last 2 years to make it clear about our intent, the change of our investment policy, that voting for that in the AGM, and then follow through in investments in EAG that complied with that new investment policy. We followed what I would absolutely describe as an exhaustive 2-year process, where the company and its advisors engaged with all possible qualified candidates that were both interested and capable of acquiring the interest. That included our joint venture partners and specifically included ARA. They were engaged with on multiple occasions, but effectively elected to assess their appetite to proceed through the preemption rights they had within the joint venture. We believe this is the best deal available on the basis that the Wen deal was the only deal tabled that was capable of acceptance, subject to a number of criteria applied by the board. I'm confident that the company has tried every possible structure during the sales process and through the negotiation process with Wentworth originally, and that includes farm out, retaining royalty, a retained element. However, there was no appetite from the buyer for this, which resulted in the structure that has been publicised. The SCIROCCO board accessed the firm value and upside consideration that far outweighs the dilutionary impact, in our opinion, and the risk exposure associated with the project, again, which Alistair touched on in his introduction. In terms of the impact of preemption by ARA, there's no impact to the company. It is precisely the same deal, including the loan terms, as the Wentworth deal originally announced. So there is no impact on SCIROCCO of the preemption. In our estimations, the consideration provides approximately 1.6 pence per share on an unrisked basis and undiscounted, and 0.9 pence per share risked and discounted over the forward payments. I'll go on to talk shortly about dilution analysis in a number of scenarios had we continued. And basically our estimate was that SCIROCCO shareholders would have been diluted by around 68% and 80% over 1 and 5 years based on the capital the company would have had to raise to fulfill its capital requirements on Rovuma. Now, it's clearly one of the issues that we have to take account of is there's no guarantee that that funding would have been available on a reasonable pricing basis, and that raised genuine risk of our ability to fund our obligations going forward and could have risked forced relinquishment for no value. A quick point on the loan component, and really this is just an explanation. What the loan component within the deal provides for SCIROCCO to draw cash from the buyer to fund cash calls on the asset during the interim period between the economic date and the completion date, subject to satisfaction of certain conditions and documentation, and also linked to the preemption or right of first refusal exercise that we're currently going through, and I'll talk about that shortly. What I want to clarify is that on completion, the aggregate amount of the loan drawn will be netted off against the normal increase in consideration that occurs associated with any further investments made in the asset between signing and completion. So effectively, the normal situation is, in a transaction of this type, is that the consideration is increased by any further costs that are incurred on the asset until completion, and those are matched by the loan from the buyer, and that increase and the loan amount effectively net off at completion. Hopefully that explains the mechanism that we're talking about here. Moving on, I'm just going to touch briefly, and people can study these slides. They will be published on the company's website later, and they can study them at their leisure. This is an example of scenario planning that the board used to look at the level of dilution that the company would potentially suffer in the event that it raised capital to fund the various elements of the project going forward. What you can see here is, subject to rounding, the cumulative dilution of 69% after raising money to fund the drilling program, and if the company went all the way through to raise capital for the development and providing assumptions that the company could raise capital at an increasing share price through that process, it still results in a cumulative dilution of 80%. So just to put that into context, that means that for any given shareholder at the outset who did not invest, they would need to see a value increase of around 5 times just to hold the same aggregate value. In terms of what else is on the slide here, in the grey table at the bottom right-hand corner, is really just using the Wentworth analogue, using current market data to imply a value of per BCF of producing gas reserves in Tanzania. And effectively that takes the market cap of Wentworth, deducts cash on balance sheet, leaving you with a net attributable value to their asset. You divide that by their stated 2P reserves as of 31st of December 2021 of 90 BCF, and you get an implied value per BCF expressed through their market cap of about £300,000, £0.3 million per BCF. And we've then used that in the left-hand column, left-hand bottom corner, to look at the implied value and the implied value per share within SCIROCCO for a number of resource outcomes, as you can see there. I'm not going through them line by line. I think the key point of that table is to highlight that given the uncertainty of what may be discovered through the Chikumbi well and the subsequent development that may happen, the value and the ultimate share price performance would be highly tied to the resource level, and there's a broad range of outcomes here. So I think the point I just want to reinforce, which we've made many times throughout this process, is that in the board's judgment, to meet the estimated capital cost through to production, it would incur certain dilution of a significant level, and that would be set against uncertain value outcomes when you take into account the various levels of uncertainty and risk in the project. and that was a significant part of our decision-making process to exit Tanzania and to move into the alternative investment strategy. The final piece of clarification linked to Rovuma, and this relates to the extraordinary general meeting that was called and held on the 29th of June 2022. Again, I'm not going to talk to every single point, but at that point, the majority of shareholders voted in favour of the disposal, which satisfied one of the key conditions in the sale and purchase agreement, or the asset purchase agreement rather, and moved it forward to closer to being unconditional. There has been a number of shareholders that have contacted the company to suggest the result did not meet their expectation, and effectively what I'm going to assure you is that we are, the board and the company, having taken legal advice, is in no doubt that the results of the EGM were correctly polled and reported, and the process was carried out in full compliance with our Articles of Association and the Companies Act. So turning to EAG, and this section really is to provide two inputs to members here. The first is to really to address certain inaccurate press coverage and assertions that we've had inbound in certain queries, and we want to correct that. And the second piece is just to reinforce the fact that we believe we have a very strong investment platform in EAG that offers the company a number of routes to grow significantly in the coming years. So first, in terms of, frankly, inaccurate questions or inbounds or even small amount of press coverage, I want to draw people's attention to a slide that I've copied in here, but it's been on the company's website since 6th of June 2021 as part of a very detailed disclosure pack around the transaction that we made to invest in EAG and the use of funds for that investment in purchasing 100% of Green and Generation Limited. What you can see here is an example of the detail that we went into, and as I say, this has been on the website since the 6th of June 2021 and available to anyone who showed any interest in looking. And it answers a number of the assertions and inaccurate statements that have been in press coverage, not limited to detailed breakdown of the use of funds, which you can see in the bottom right-hand corner, and a detailed description of the structure and how SCIROCCO participates in a shareholding in EAG and has invested for EAG to buy 100% of Green Generation Limited. So moving on, where are we with EAG? And I think I draw your attention primarily to the headline here, which is that the EAG team have assured us and have demonstrated to us that they have an immediately investable pipeline across the UK, which would easily get to £10 million of deployable equity. This is an opportunity to put money into very attractive plants and situations that they've identified. Really, just as a reminder, the JV that we've entered into with EAG, that 50% holding in EAG, it provides us access to a highly compelling pipeline of opportunities across renewable and circular economy, principally in AD plants, and EAG is currently engaged in carrying out diligence on 3 additional AD plants that they believe they can acquire, which would be very similar to Green Generation Limited. I'd remind shareholders that under the arrangements that we entered into with SEM, which was announced on the 9th of December last year, the company and EAG gained exclusive access to a technical solution for the processing of digestate into and effectively recovering nutrients and converting that into a highly valuable organic fertilizer capable of being substituted for artificial fertilizer or chemical fertilizer, which is very prominent in the news at the moment. EAG is also engaged in discussions with up to 7 merchant installations of that nutrient recovery equipment, which could lead to a large portion of that investment and very significant increase in cash generation. And specifically, EAG is planning to install a nutrient recovery system at Greenan, which, once installed and up and running and commissioned, would increase the EBITDA to an estimated level of about £1.5 million per annum. So these are the economics that we are pursuing with these plants. And I think if you start to add up a number of these plants generating that sort of income with a much lower level of uncertainty, I think you can see the attraction that the board is attempting to pursue with our restated strategy. So I'm going to turn to board performance again, really to address a number of questions that have come in. And effectively, what I'm going to juxtapose here is strategic delivery against a challenging market backdrop, whilst acknowledging that no one is happy about the share price performance over the intervening period since this board was formed, starting in 2018 and subsequently in 2019. I think we're going to start the clock when Alistair stepped in August 2018 in the capacity of chairman, and then I joined at the end of 2018, was further augmented in 2019. What has this board achieved? Now, there's a list here, and I'm going to go through them bullet by bullet, just really to reinforce the various elements here. So I think first and foremost, we've enhanced all aspects of the company inherited from the prior board in terms of funding, governance, legacy, investment relationships. It was not in good order, and it took a lot of time, money, and effort to sort out. We set the company on a new sustainable growth path with clear strategic vision, and we've now executed a first investment in EAG that we just discussed with a strong forward pipeline that could consume investment capital to good effect, in our view. We created strong shareholder alignment through collective holding of over 3% of issued capital at board level. We have eaten our own cooking, and both Alistair and I invested in 2018 and still hold all those shares, and have been on that journey with shareholders throughout. We've maintained strict cost discipline, which included director salary sacrifices in 2020 and 2021, which is borne out in the annual accounts. We maintained open shareholder engagement. We operated regular events, including through COVID. We operated interactive webinars, Q&A sessions, and via appointed IR firm Buchanan. We've also rationalized the legacy portfolio and realizing, in many cases, maximum value from legacy investments. So including Horse Hill, where we sold in 2018 and harvested a significant amount of cash that you can see on the slide here. Current market value of those shares would be significantly lower at £0.2 million. In Helium 1, we obviously worked closely with Helium 1 through and up to this point of listing. Then we were in a position to take money off the table in 2021, and the £3.4 million that we generated from the sale has provided us an opportunity to reinvest in all of our assets, but in particular behind the new investment strategy. In terms of the share price here, what this is showing is the share price since the current board took over. It's annotated to show a number of directions here, I think what I would characterize this as there's clearly a trend down to the right, which when we look at the next slide, which shows a much longer term trend, I think is not out of kilter with the companies who are active in Tanzania in many respects. What you can see is at points in which the board have taken action to develop the company, the share price has responded well, but then suffered a significant sell-off through, we can only surmise, people selling off and taking profits. In terms of in 2019, the share price ran up and we announced the Project Orange Horse deal. We've talked about that a great deal. I'm not going to go over that again today. But the share price, when we came out of suspension and that deal had not completed, obviously failed, and that was against the backdrop of the COVID plummet that we saw across the world markets. The share price recovered, and when the Aminex farm-out was completed with ARA, we saw a significant pop-up, but you can see then a rapid sell-down during 2020. We then started to develop the new strategy and proposed the deal with EAG. Again, you can see a spike up of interest and people buying into the stock, which also decayed pretty rapidly. And then over the last few months, there has been a reasonably consistent decay, despite making positive statements in our view. I think what this tells us is that we're not in control of the share price, despite taking positive steps forward. I would underline the point that Alistair, I, and others involved in the business have invested in 2018 and have been on this journey alongside every other shareholder. Looking at a 10-year performance comparison here of SCIROCCO and Aminex, and the point of this slide really is summarised in the key points in the box. Looking back to 2012, you can see that SCIROCCO and Aminex have have tracked reasonably closely all the way through. And that's despite Aminex entering into an agreement to farm out and be fully funded for its share with ARA. And effectively what this is, in my view at least, is that long-term lack of progress and news just means that the value of a single asset company in this space, even when it is fully funded, as Aminex is, just leads to uncertainty and value decay. And effectively what we're trying to produce here is a strategy that we're in control of, we can push forward, and we can grow the business through acquisitions in the new strategy and break out of this pattern. On this slide, I just want to talk through cash movements again to answer and address some questions that we've had inbound since the board has taken over. And effectively, this is a summary of the application of cash and cash resources over the 4 years, end of 2017 to end of 2021. All of the information used in the slide is sourced from the company's annual reports. Starting on the left, you can see there's a significant starting balance, if you like, based on the cash balance at the end of 2017, added to placings the company have engaged in and the proceeds from sale of assets. And I'm not going to talk about every single block here, but you can draw your eye. The biggest single cost is the costs associated with third parties, including accounting, costs of listing, which I would include the company's nominated advisor, financial PR, legal advice. That also includes abort costs associated with Project Orange Horse, which are not insignificant. The next largest cost on this slide is Tanzania at 18.4%. So this is investments made in the Tanzanian assets during that period. You can see there's a slightly darker block there, which includes a direct allocation of costs that would otherwise be shown in Nice Energy, but that's because it's a direct operational support provided by Doug Rycroft, company's CEO, to the Tanzanian assets through the joint venture forum. The next largest element is other investments and debt repayments, which this board inherited from prior commitments that the company had made, including the repayment of the Riverfort facility, for example. It really, in sort of tying off, I would talk about Nice Energy, which has been the subject of some scrutiny, and I'll come on and talk about in a moment in more detail. But you can see it's by no means the largest cost, and spread over 4 years, that represents costs associated with placings that were run and transactions that were concluded and advised on, where fees would otherwise have been incurred by other advisory firms to do the same work scope. And they have been independently reviewed at each stage, and I'll come on to that in more detail. And then the final point here, the smallest block on this is directors' remuneration at 4.6%. So turning to Nice Energy, really just to clarify the company's relationship with Nice Energy and to talk through some of the background here. We believe that Nice is a critical outsource partner providing advisory expertise on a number of disciplines. We've maintained an ongoing relationship with Nice Energy since the late 2017, obviously before the current board's appointment, for a broad range of activities, including corporate finance, corporate broking, A&D advisory, operational support, general manager of the business, I mentioned Doug Rycroft, including the provision of Doug as COO and company secretary. So a really broad scope of activity and a really broad scope of support, many of which, particularly the COO role and company secretary role, would have required to be found elsewhere and effectively incur costs elsewhere. Former non-exec director and Nice Energy founder John Fitzpatrick has invested £650,000 approximately in the company, and he remains a material and supportive shareholder. He left the board at the AGM in 2021. All of the commercial arrangements between the company and Nice Energy have been fully disclosed to the company's advisors, including its nominated advisor, external lawyers, in order to ensure that all the arrangements in place are market standard. This includes the current arrangements, which were renegotiated by the company last year, 2021, to reflect the new strategic direction of the business and to make sure we got appropriate support. Centralising our advisory support and operational management into a single third-party provider has been cost-effective, we believe, and allowed the business to maintain flexible G&A costs over a period of nearly 5 years. And we've had stability through that 5-year period as well. Each of the financial aspects of these arrangements have been discussed, has been disclosed in the annual accounts and reviewed by our external independent auditor. And then finally, in terms of how those new arrangements were negotiated, independent directors responsible for reviewing the relationship and appropriateness of those commercial terms on an annual basis with limited oversight from the Chairman and CEO. Okay, the final part before we get on to, here's a piece on prolific basins. Again, this is really to address some of the questions we've received. In June 2020, the company entered into an investment facility for up to $5 million with Specialist Investment in Natural Resources Prolific Basins, LLC. The structure was tranched, meaning that we could draw down on a flexible basis should it be required, and it was principally to support planned appraisal program on the Notoria gas field at that time and for general working capital purposes. The facility enabled the company to maintain its cash calls and commitments under the JOA, totaling about $1.6 million since June 2020. And in doing so, it meant we could retain our 25% interest in Rovuma through the sales process. So critical, and this is why it's in bold in this slide, that facility was an essential source of funding to ensure the company didn't default on its obligations and risk relinquishing its interest in Rovuma for no value. So the board assessed that at the time as the best source of funding, given lower risk dilutionary impact versus an equity raise at that point in time in 2020, or the prospect of asset relinquishment. As the recent RNS stated, on the 21st of July, an aggregate of $1.5 million of the total $2 million subscribed for to date has been settled through the issue of ordinary shares in SCIROCCO. And I'm going to restate the point that was in the circular for the AGM, that failure to pass Resolution 5 here could potentially result in a breach of the subscription deed and a potential acceleration of the amounts owed by the company to Prolific, which currently stand at $545,000. Therefore, it's very important that Resolution 5 is passed and to avoid a potential material negative impact on the company and its financial position. I want to restating that based on the circular just to make sure that shareholders voting at today's AGM understand the gravity of the matter. So really, I'm going to summarise now our strategic objectives looking forward before we open up to the floor. First and foremost, completely in line with our new investment policy, our focus going forward is in the low carbon, sustainable and circular economy sectors, looking to identify long-term growth opportunities in a backdrop of favourable market drivers and better access to growth capital. We've partnered initially through EAG in a joint venture which aligns us with sector experts with established network and proven capabilities and domain knowledge in the AD and nutrient recovery space. And we see lots of opportunities to invest alongside EAG going forward. The disposal of Rovuma strengthens the balance sheet. It removes material near-term dilution, as I've already talked about today, and it removes oil and gas exposure, which allows a clear strategic focus and broadens investor appeal to SCIROCCO going forward. And finally, we're seeking to build a balanced portfolio of cash generative assets within that stated strategy to underpin the company as a stable, profitable cash deliverer. So really, just in summary, before we open the floor to Q&A, I want to be really clear. The Rovuma disposal represents a final chapter of the legacy company and provides a strong growth platform for achieving the strategic objectives that I've just described. The board are committed to executing a focused growth strategy to generate long-term value for all shareholders, and the EAG investment and opportunity pipeline provide our first set of follow-up investment opportunities, and we believe they represent compelling value catalysts and have a very strong positive outlook. So.
Thank you, Tom. I hope you all found the presentation helpful. And given our interaction with you over the last few months, in particular with reference to the questions that we received prior to today, we hope that the presentation went some way to deal with a large number of those queries and concerns which shareholders have. So prior to the formal business of the meeting and the resolutions, we'd like to give you as shareholders the opportunity to ask further questions. Now it's now just before 10 past 11. So if you have a question, I mean, please feel free to ask it. If we could maybe ask that the person states their name, right? And confirm that they are a shareholder, and then ask the question. We'll do our best to answer as many questions as possible, and we look to finish, up around about 11:45, depending on the amount of questions. So if that is clear and understood, can we take any questions, please?
Okay, so there being no questions from the floor, I'm going to turn to questions that have been submitted through the webinar platform. So the first question here is, and I'm going to read the questions in full. Only a few months ago, you had nothing but praise for the Rovuma asset, and a recent RNS stated that funding was being arranged to keep the asset should it not be sold. What has changed your mind in a matter of months and made you accept such an awful deal for a world-class asset? So, a number of things there. So the first and foremost, we've always had praise for the potential of the Rovuma asset, but we have also consistently stated that it was our intention to divest it because it wasn't the right asset for our size, given the timeline, capital requirements, potential risks and uncertainties, and it was consistent with our growth strategy to sell it. I want to be really clear here in answer to the embedded question. We did not say that funding was being arranged. We made a very clear statement that if the asset should not be sold, we would take steps to avoid default by ensuring we had access to capital, and that's a critical distinction. So this question is a misstatement, and I want to make that very clear. So we had made it very clear that it was our intention to avoid default, and we would raise money should the asset not be sold. And we have come to an agreement with a third party to sell the asset. So, and finally, the point, which I'm probably going to repeat myself a number of times as we go through this Q&A, is we believe the deal we brought to shareholders and what was subsequently voted through at the general meeting is the right thing for the company and all of its shareholding, and it is a settled matter. Okay, moving on to question 2. Again, just reading it to make sure there is actually a question. So, reading it out in full, the best option now for shareholders is to sell the company for £10 million plus, which is easily achievable and would void the existing lowball Wentworth deal. Shareholders would get 1p plus for every share, which in my opinion will not be achieved for at least 4 to 5 years if the company continues with its current strategy. What is your response to the statement? So, I really just have to say that I just strongly disagree with pretty much every single assertion in that question, which is fundamentally riddled with misguided opinions and assumptions about valuation timelines and potential outcomes. It's just plain wrong. We believe that following the completion of the divestment of Rovuma, the company will re-rate in the market based on fundamental valuation of cash-generative assets that we own either directly or through joint ventures, and will provide us with cash flow to continue growth. Can't speculate about how quickly the market will recognise that through the share price, but obviously you have to do the work first and demonstrate that you're capable of getting after it. Moving on to question 3. Could you please disclose the Rovuma deal proposed by the private equity group that was rejected by the current board of directors? I think this has been mentioned on a couple of occasions on the basis that throughout 2020 we were engaged with a private party. We're not going to disclose the nature of the deal or the counterparty on the basis that it didn't reach heads of terms despite being an extended negotiation. Fundamentally, they failed to satisfy us on both commercial terms and that they could deliver upon them, and that's why the process ended. The next question here is, Shareholder value equals share price. Since the current board of directors took over, the share price is reduced by 90%. What is the plan to get the share price back above 2p, and what are the time scales, I think that means? So fundamentally, as I've already said in the presentation, none of us are in any way satisfied or happy with the share price performance. As I mentioned, Alistair and I both made investments in 2018 and has suffered exactly that percentage drop that's quoted in the question. Our plan to get the share price back is the investment plan and growth plan that we've outlined, and the strategic plan, which is to use the company's resources to build a base of cash generative assets through joint ventures and direct investment in the sustainable energy and circular economy space, and being able to demonstrate to the market that we have a growing body of cash generative assets capable of recycling cash into buying more assets in an attractive, dependable sector will ultimately be recognised by the market in our view, and that will result in positive share price appreciation. But I can't put a timescale on that. The next question is, you lost the One DS deal, and maybe shareholders could have given you the benefit of the doubt, but the large majority of shareholders was waiting for the drill, not the sale, as you stated. One anaerobic digestion unit delivered so far, but needed cash for maintenance interests elsewhere, so failure on all fronts. How can shareholders trust you now after so many disappointments to deliver growth in the share price? So again, I think there's a large number of misplaced assertions in the question, and it's really more of an editorial statement than a question, but I'm going to address a couple of these points regardless. Over the last 2 years, we've made our proposed strategy explicitly clear and consistently clear in pretty much every statement we've made to the market. In early 2020, we announced that we were planning to start a process to sell Rovuma, recycle the value into a new strategy, which we clearly outlined. We took that new strategy to the AGM last year and got that overwhelmingly approved by shareholders at the AGM. We then made our first investment in EAG, which is completely compliant with that new investment policy. And in my view, and just from a point of view of fact, that investment has outperformed original expectations, and the team has done a great job both on that first asset and on developing an interesting pipeline of developments. So in terms of implementing, so basically coming up with the strategy, putting it in front of investors, communicating it consistently over a long period of time, and taking all relevant actions to implement it, and now the first result, I think that's entirely compliant with what we've been saying, and actually does represent robust performance and delivery. So fundamentally, really point you to that, and more of that is the path to growth and growth in the share price. Next question, picking up here, why didn't you negotiate a deal where Wentworth would pay more upfront? If not all the money upfront, SCIROCCO has made significant investment in the scheme, and we're not getting anywhere near back in the first instance. I think I covered this in the presentation, but it is worth restating. An exhaustive 2-year process where we talked to all potential interested and capable counterparties. We explored all potential structures, means of payment, deferred payment, farm out, retaining a section, and it wasn't available. And ultimately, you can only take the offer that's made to you from a capable, interested, engaged, funded counterparty, and that is what manifested in the WEN offer that we announced. So believe me, we went through hoops and hoops of and recycle loops of attempting to deliver alternative deals with alternative payment structures. The one we announced was the one we concluded on, and it's the best deal that we have. And I think it's worth saying that it continues to provide cash, and it provides us with a significant amount of cash going forward if the asset ultimately delivers. You suggested dilution of share value if we continued. Haven't we spent the last year selling other assets to fund the future investment needed, Helium-1 shares, etc.? Or has all this money been spent on excessive management fees? Okay, so excessive management fees, I'll point you to the answer I gave a moment ago. I'm not going to talk any more about that. But we are an investment company. Our business is involved in selling historic assets to harvest cash and reinvest in new investments. That's what we do. And I think if you look at the prices achieved by the sale of Helium 1, I think we did pretty well in taking value off the table when we did. And we now have a really interesting asset in our joint venture in EAG as a result, which not only has an outperforming cash generative asset under its hood, but a lot of potential very strong opportunities to invest. And I think that's what our job is as a board of an investment company. Next question is, when will my share investment return to a similar level to my initial investment 5-6 years ago? When will the share be worth over 2p? I cannot, and nobody in this room, and I don't think anybody on this webinar can speculate about timing. As I've already said, what we can do is what is in our control is to pursue a very clearly stated strategy to grow the business, grow its cash flow, recycle into more assets, and build a robust, stable, cash generative asset base, which ultimately any market will not be able to ignore and will have to value appropriately. Next question here is in February. Oh, something just changed. Right, okay. In February 2021, you stated SCIROCCO will focus on energy, vector, circular. How do you think you're going on all three targets? So I think we've got a tick in the box of energy in that we established a joint venture with EAG, which is principally anaerobic digestion and generation of energy. So I think we've got our first platform in that space. I think with the digestate management stuff we're looking at, which effectively reprocesses and recovers nutrients from that and has the ability to push it out as product and as fertilizer, I think we're moving towards ticking the box in circular, albeit under the same platform. In vector, we have looked at a number of situations, but fundamentally we wanted to focus on what we have with EAG and within the limited resources we currently have. But I think we've made progress on all three targets in the interim period. So this is becoming a conversation. Okay, there's a question here. You've been, oh, something has shifted on there. Okay, there's a question here. Has the option been looked at to delist the company and run as a private company to distribute the milestone payments from Wentworth and income from EAG? Costs associated with being listed seem too high for a company with 2 million market cap. So no, we have not looked at that. It hasn't been something we've looked at. I do agree that the costs associated with being listed on an annual basis are significant and represent a meaningful portion of the cost consumption that I showed you in that slide. What we are trying to do is to effectively grow the business through further investment in an asset base. So effectively we grow into being relevant as a listed company and can more appropriately deal with those sorts of costs. And then the final question here says, I agree you have sold well, but where is the money? You haven't invested all the money back into the business. I think if you go back and look at the slide that I presented, you can see there is a remaining box at the bottom end, bottom right, which corresponds with the cash that was remaining in the company at the end of 2021. So I agree we haven't invested all of the money because actually, as I just answered in the last question, the company does need a certain amount of money for working capital and to remain listed and to pursue general activity. And obviously we can't just invest all of the money immediately into other assets. I think that's the end of the questions that we have here. So with that, hand back to Alistair.
Okay, thank you very much, everyone, for all the questions. It was quite a range of things to go through, but I hope this at least helps, clarifies not only some of the questions that were raised directly for the audiocast, but actually some of the questions that were raised with both Tom and I in independent individual correspondence from shareholders. So thanks again for that. Now, I'd like to draw the Q&A session to a close and move on with the kind of formal business of the meeting. With your permission, first of all, as part of the first part of the formal business, I would like to take the notice of the AGM as read. That is acknowledged. I will now start to propose the resolutions to the meeting. They will follow in the order as they appear in the notice of the AGM, of the AGM circular, which sets out the full text of each proposed resolution. Just to remind everybody, resolutions 1 to 4 are proposed as ordinary resolutions and require a simple majority to be passed. Resolutions 5 and 6 are proposed as special resolutions, which to be passed require a majority of 75% to vote in favour of the resolution. Now, as noted in the notice of the meeting, a poll will be carried out on each resolution in turn, and there will be no vote by hands. The poll will be undertaken by the company's registrars who are present with us here. And the results will be announced later this afternoon after the meeting. Right? So therefore, in terms of the resolutions, and I will just read out the summary. Resolution 1 is to receive and consider the accounts for the period ending 31st December 2021. I now call a poll on Resolution 1. Resolution 2 is to reappoint Donald Nicholson as a director of the company. I now call a poll on Resolution 2. Resolution 3 is to reappoint PKF Littlejohn LLP as auditors of the company. I now call a poll on Resolution 3. And Resolution 4, the last of the ordinary resolutions, is to refresh the Director's general authority to allot shares. I now call a poll on the Resolution 4. First of the two special resolutions, Resolution 5, is to disapply preemption rights in respect of prolific subscription deed to allow us to satisfy our obligations thereunder. Right? I now call a poll on Resolution 5. And lastly, Resolution 6 is to disapply preemption rights in general to allow the company to issue shares. I now call a poll on Resolution 6. So that concludes the formal business of this AGM. Final results of the polls called at the meeting will be announced to the markets through our regulatory information service and posted on the website as soon as practically possible. I now declare the meeting closed, and thank you for your attendance and participation today. Thanks very much.
Thank you very much indeed for updating attendees today. Can I please ask attendees online not to close the session, to be automatically redirected to provide your feedback, in order the board can better understand your views and expectations. This will only take a few moments to complete. I'm sure it will be greatly valued by the company. On behalf of the board of SCIROCCO Energy PLC, we'd like to thank you for attending today's annual general meeting proceedings. Thank you very much and good morning to you all.